Today we're going to be looking at the business plan, and the business plan is a culmination of all the work that you've done from the beginning of the semester where you looked at audiences and what audiences were doing um, with media and how audiences were spending money and how audiences were doing whatever they do, their lifestyles and things like that. And then you began to develop your ideas, and from those ideas you did a SWOT analysis, and the SWOT analysis allowed you to look at the strengths, weaknesses, opportunities, and threats. From the SWOT analysis you were asked to do the marketing analysis, and the marketing analysis allows you to look at all things related to your competitor and yourself, and also to look at items important to the overall business plan that you'll be doing. So after the marketing analysis is done and the SWOT analysis is done, then it's easier to begin to think about the business plan itself. And so what we're going to be doing today is looking through the business plan and what should be included in the business plan. One of the most important parts of the business plan is the executive summary, and many times individuals will say that you really want to wait to do the executive summary until you've done everything else so that you can summarize what you're really wanting to talk about. So in the executive summary, it's important that you talk about the business owner and the products that exist. Who are you? And what qualifies you to operate this business? And then what is the product or service? You need to provide a description of the product or service that you plan to supply to the consumer. Then you have to have a mission statement. And this is really important, and a lot of people don't spend enough time on a mission statement. But the mission statement is a brief description of what you will do to be successful and what your guiding principles are. Will you provide a service that provides a community focus? Will you talk about your passion for the business and the community in which you serve? Those are elements that could go inside a mission statement. At Arkansas State University, we have a mission statement to educate individuals. You may, with your business, have a mission to educate someone about certain things, but more likely you're wanting to educate them about the services that you provide. And let's say that the service you provide makes somebody's life easier. Well, that's an important aspect of who you are. In addition, it's important to talk about the very principles that you adhere to, the kind of reactions that you actually follow in certain situations. People need to know who you are. Well, that was interesting, but it's good to know that my computer is working correctly. The next element of an executive summary is to address the company's business structure. And this is going to be a little bit lengthy because I am actually going to talk about specific types of companies that you could actually have and the positive and negatives of those particular company structures. And so this slide is going to stay up for quite a while because I am going to talk about the business structures. And that gets into a lot of information here. So let's do that first. The company structure. You may decide that you are going to be the sole proprietor. And a sole proprietor is the simplest and most common structure chosen to start a business. It is an unincorporated business owned and run by one individual with no distinction between the business and you, the owner. You are entitled to all the profits and are responsible for all of your business debts, losses, and liabilities. And this is an important element. Sole proprietorship is not necessarily a good way to start a company. it would be better to do something a little bit different. With a sole proprietorship, you do not have to take any formal action to form a sole proprietorship. As long as you're the only owner, the status automatically comes from your business activities. In fact, you may already own one without knowing it. If you are a freelance writer, for example, you are a sole proprietor. But like all businesses, you need to obtain the necessary licenses and permits that you need to operate as a business. So just because you're a sole proprietor doesn't mean that you don't follow the regulations that exist. You will need to use the licensing and permits in your federal, state, and local, any of those licenses and permits that you need. And you will need to register your company as you run your business. If you choose to operate under a name different than your own, you will most likely have to file a fictitious name, also known as an assumed name, trade name, or a DBA name, short for doing business as. The DBA is short for doing business as. You must choose an original name. It cannot already be claimed by another business. And that's why it's so important to do those searches like that. So proprietorship taxes. Because you and your business are one and the same, the business itself is not taxed separately. The sole proprietorship income is your income. You report income and or losses and expenses with a Schedule C and the Standard 1040. The bottom line amount from Schedule C transfers to your personal tax return. It's your responsibility to withhold and pay all income taxes, including self-employment and estimated taxes. And you can get all of that information at irs.gov. There are some advantages of a sole proprietorship. One is it's simple. It's the least expensive business structure to establish. Costs are minimal, with legal costs only limited to obtaining the necessary license or permits. You have complete control as the sole owner of the business. You aren't required to consult with anyone else when you need to make decisions or want to make changes. It's relatively easy to do taxes. Your business is not taxed separately, so it's easy to fulfill the tax reporting requirements for a sole proprietorship. And the tax rates are also the lowest of the business structure. But there are some disadvantages. One is you take on personal, unlimited liability. Because there's no separation between you and your business, you can be held responsible for all debts and obligations of the business. This risk extends to any liability incurred as a result of employee actions. It can be, as a sole proprietor, difficult to raise money. Sole proprietors often face that challenge because you can't sell stock in the business. Investors won't often invest. Banks are also hesitant to lend to a sole proprietorship because of perceived lack of credibility when it comes to repayment if the business fails. There is a heavy burden. The flip side of the complete control is the burden and pressure it can impose. You alone are ultimately responsible for the successes and failures of your business. There is another type of company, though. And this type of company is called an LLC. That's Limited Liability Company. This is a hybrid type of legal structure that provides the limited liability features of a corporation and the tax efficiency and operational flexibility of a partnership. The owners of the LLC are members. And depending upon the state in which you have an LLC, the members consist of a single individual, two or more individuals, a corporation, or other LLCs. Unlike shareholders in a corporation, LLCs are not taxed as a separate business entity. Instead, all profits and losses are passed through the business to each member of the LLC. The LLC members report profits and losses on their personal federal tax returns, just like the owners of a partnership would. This limited liability partnership is oftentimes the one that you'll see used. Then there's also a corporation, and you'll see it sometimes referred to as a C corporation. Corporation is an independent legal entity owned by shareholders. This means that the corporation itself, not the shareholders that own it, are held responsible for liability for the actions. It's the corporation. Corporations are more complex than other business structures because they tend to have costly administrative fees and complex tax and legal requirements. Because of these issues, corporations are generally suggested for established, larger companies with multiple employees. Now, for businesses in that position, corporations offer the ability to sell ownership shares in the business through stock offerings. Going public is the term used, and that indicates an initial public offering, or an IPO, initial public offering. And that's a major selling point in attracting investor capital and high-quality employees. Now, when forming a corporation, it would be formed and registered under the laws of the state in which it is registered. And to form a corporation, you'll need to establish your business name. Register your legal name with your state government. If you choose to operate under a name different than the officially registered name, you'll most likely have to file a fictitious name, trade name, or DBA name for doing business. State laws do vary, but generally corporations must include a corporate designation as Corporated, Incorporated, Limited at the end of the business name, so Inc. To register your business as a corporation, you need to file certain documents, typically articles of incorporation, and you have to file them with your state Secretary of State's office. Some states require corporations to establish directors and issue stock certificates to initial shareholders in the registration process. You'll need to contact your state to find out how to do that. Corporation taxes. Corporations are required to pay federal, state, and in some cases local taxes. Most businesses must register with the IRS and state and local revenue agencies and receive a tax ID or permit. When you form a corporation, you create a separate tax-paying entity. Regular corporations are called C corporations because Subchapter C of Subchapter 1 of the Internal Revenue Code is where you find general tax rules affecting corporations and their shareholders. Unlike sole proprietorship and partnerships, corporations pay income tax on their profits. In some cases, corporations are taxed twice. First, when the company makes a profit, and again when dividends are paid to the shareholders on their personal tax revenue. So that's one reason that some people sometimes don't like to use a corporation. They would rather do something different. There are some advantages to a corporation. When it comes to taking responsibility for business debts and actions of a corporation, shareholders' personal assets are protected. So if a company goes bankrupt, the shareholders don't go bankrupt with it. Whereas with an LLC, that's not necessarily the same. You could. With a corporation, you're able to generate capital. That means raising money to purchase other capital items. Corporations file taxes separately from their owners. Owners of a corporation only pay taxes on corporate profits paid to them in the form of salaries, bonuses, and dividends, while any additional profits are awarded a corporate tax rate, which is usually lower than a personal income tax rate. Corporations are generally able to attract and hire high-quality and motivated employees because they offer competitive benefits and potential for partial ownership through stocks. There are some disadvantages, though. Corporations are costly and time-consuming ventures to start and operate. Incorporating requires startup operating tax costs that most other structures do not require. In some cases, corporations are taxed twice, first when the company makes a profit and again when it's paid out. Additionally, there's extra paperwork that may be required of you and record keeping burdens that are associated with it. So these are some things that are important to know about business structures that exist out there. Another type of company structure is called the cooperative, and it is different from forming any other business entity. To start up, a group of potential members must agree on a common need and a strategy on how to meet their needs. And typically an organizing committee then conducts exploratory meetings, surveys, and cost and feasibility analysis before every member agrees with the business plan. Not all cooperatives are incorporated, though. Many choose to do so sometimes. If you decide to incorporate your cooperative, you must follow the following steps. You must file articles of incorporation to legitimize your cooperative and include information like the name of the cooperative, business location, purpose, duration of existence, names of the incorporators, and capital structure. You must create a set of, or you should create a set of bylaws. They do need to comply with state law and are essentially the success of the cooperative. Bylaws list membership requirements, duties, and responsibilities. To create a membership application, you have to recruit members and legally verify that they are part of the cooperative. You must create and issue a membership application. And you'll have charter member meetings and elect directors and that sort of thing. Most businesses need to register with the IRS if they have formed a cooperative. You register with state and local revenue agencies, and you do obtain a tax ID number or permit. A cooperative operates as a corporation and receives pass-through designation from the IRS. Cooperatives do not pay federal income taxes as a business entity. Instead, the cooperative members pay federal taxes when they file their personal income tax. Members may pay federal and state income taxes on the margins earned by the cooperative, though the amount of taxation varies by state. So the cooperative is a little bit different. Cooperative, some of the advantages, there's less taxation. Similar to the LLC, cooperatives that are incorporated normally are not taxed on surplus earnings. Therefore, members of the cooperative are only taxed once on their income from the cooperative and not on both their individual and cooperative levels. There are funding opportunities for cooperatives. Another aspect of the cooperative is that it brings little disruption and more continuity to the business. Unlike other business structures, members in a cooperative can routinely join or leave the business without causing the business to go away. There is a democratic organization. Democracy is a defining element of cooperatives. The democratic structure of a cooperative ensures that it serves its members' needs. The amount of a member's monetary investment in the cooperative does not affect the weight of each vote, so no member owner can dominate the decision-making process. There are some disadvantages. Cooperatives may suffer from slower cash flow since members' incentives to contribute depends on how much they use the cooperative services and products. While the one member, one vote philosophy is appealing to small investors, larger investors may choose to invest their money elsewhere because a larger share of investment in the cooperative does not translate to greater decision making. And if there's oftentimes a disadvantage of the lack of membership and participation. Sometimes members don't fully participate and perform their duties, whether it be voting or carrying out daily operations of the business. There's another type of business, and it's called a partnership. A partnership is a single business with two or more people sharing ownership. Each partner contributes to the overall aspects of the business, including money, property, and labor. In return, each partner shares in the profits and losses of the business. Because the partnership includes more than one person in the decision-making process, it's important to discuss a wide variety of issues up front and to develop a legal partnership agreement. And this agreement should document how future business decisions will be made, including how the partners will divide profits, resolve disputes, and change ownership, and how to dissolve the partnership if they choose to do so. Although partnership agreements are not legally required, it's really a good idea. There are three general types of partnership arrangements. There's a general partnership that assumes that profits, liabilities, and management duties are divided equally among partners. There's a limited partnership, or these are a little more complex than those general ones. Limited partnership allows members to have limited liability as well as limited input with management decisions. These limits depend on the extent of each partner's investment percentage. Limited partnerships are attractive to investors of short-term projects. Joint ventures act as a general partnership, but for only a limited period of time or for a single project. Partners in joint ventures can be recognized as an ongoing partnership if they continue to venture, but they must file as such. When you form a partnership, you must register your business again with your state and go through the process generally, which normally means going through the Secretary of State's office. You do have to have a business name, and you may have a fictitious name. And then you have to go through the regular processes of filling out licenses and permits and things like that. You must pay taxes, therefore you must register with the state and local revenue offices, and you must have a tax ID to operate. A partnership must file an annual information return to report the income, deductions, gains, and losses from the operation. The business itself does not pay income tax. Instead, the business passes through any profits or losses to its partners. Partners include their respective share of the partnership income or loss on the personal tax returns. Some of the advantages of a partnership. It's typically easy and inexpensive. Partnerships are generally an inexpensive and easily formed business structure. The majority of time spent starting a partnership often focuses on developing that partnership agreement I spoke about earlier. There is a shared financial commitment. Each partner is equally invested in the success of the program and the business. A good partnership should reap the benefits of being able to utilize the strengths, resources, and expertise of each partner. Partnership incentives for employees. Partnerships have an employment advantage over other entities if they offer employees the opportunity to become a partner. Partnership incentives often attract highly motivated and qualified people. There are some disadvantages to a partnership. Similar to the sole proprietorship, partnership retains full shared liability among the owners. Partners are not only liable for their actions, but also the business debt and decisions made by other partners. In addition, the personal assets of all partners can be used to satisfy the partnership debt. Another disadvantage is there's bound to be some disagreement between partners. That's why it's important to have an agreement in place. Shared profits. Because partnerships are jointly owned, each partner must share the success and profits, but at the same time, if there are issues and there is no income, then they must share the losses as well. So those are important elements to remember in forming a company structure. Additional elements of the executive summary include identifying who your target market is, who are the customers, who are the consumers, who are the people that you're going to focus your attention on. And then you're going to identify, excuse me, in the executive summary why this opportunity currently is available to you. And you're going to pitch your idea, your technology, your service. You're going to address whether there's competition or not. You're going to identify whether or not you have special skills needed to carry out such an endeavor. And then you're going to do projections for the business future. You're going to suggest that this is a timeless opportunity, a limited opportunity. What's going to happen in the next 5 years for a company like this? And then you'll need to identify very briefly the amount of money that you're seeking for this venture, the estimated costs of the startup, the projected average monthly expenses, and the projected average monthly revenues. And that all goes inside an executive summary, and everything that follows that executive summary is very much a part of things that you have already, in essence, worked on. We're doing a market analysis, and I want you to address all the items that you addressed in your market analysis document. And so everything that goes in that market analysis that you did will go into this particular part of your paper. You will need to address the competitive analysis. You will have to identify every aspect of your competitors and who your competition is. And basically, you're moving the entire market analysis into this section of the business plan. And if you did your market analysis correctly, you'll have all the materials that you need to go into your business plan right here. And that is an extensive portion of the actual business plan. And then the second element of that is the marketing strategy. And that element includes talking about everything from your product and services that you offer, to your sales strategies, to the promotions you do. How much are you going to charge? What are you going to do web-wise? And then the competitive advantages. And that's that table that you'll find at the end of the document. And one of the things that I want to talk about a little bit is the pricing strategy that you have, because the products and services, that's one thing. Your sales strategy also, I want to go back to that for just a second. Sorry about this. What is your sales strategy? How will you get your product or service to the market? What kind of sales will you use, and what kind of channels will you distribute it? And a lot of that is inside the marketing analysis that you've already done. And one of the elements that you actually have not done inside the marketing analysis is the pricing strategy. And that is, how are you going to price your product or service? Look at the competition's pricing. What do you believe your cost might be? And then, can you get the same price or a premium over the competition? There's something called penetration pricing strategy. Prices charged is set artificially low to gain market share, and once you achieve that, you increase the price. That's one strategy that you could use, penetration pricing strategy. Another element is called skimming pricing strategy. And that is, you charge a high price because you have a substantial competitive advantage. However, the advantage is typically not sustainable in this case. A high price tends to attract new competitors into the market, and the price inevitably falls due to increased supply. There's another strategy called follow the leader's pricing strategy. You set prices based upon your competition, and oftentimes that leads to some kind of price war. You can also do what you would call a variable pricing strategy. In this particular case, your price fluctuates based upon changing cost of production. Then you have economy pricing. And this is no frills, low price. The lowest possible regardless of what others are doing. Costs of marketing manufacturers are kept at a minimum. And the opposite of economy pricing is what you would call premium pricing. High price is for the uniqueness of the product or service. And this is where typically you're going to have a substantial competitive advantage. And that's when you're going to price high. Also, the web strategy that you use. What will you use to form your website? Are you going to have... Well, that's always fun when someone actually contacts you in the middle and tells you that they're doing something. So anyway, that's so much for having your iMessages on. But anyway, back to the web strategies. What is your competitive advantage? And this makes a difference in everything that you do. Why will you succeed? What will you do different than the competitor? These are called your core competencies. What you do well that perhaps the competition does not. You can list your core competencies. For example, superior service levels, exceptional quality, speed, better products and services, better location. But remember, as I've stated all along, those are typically the standard. If you say you're going to have superior service, then tell me what that means. Simply saying that it's going to be and applying an adjective does not mean anything until you explain what it is that's going to make you different. If there is enough differentiation, you can be successful. If there is little or no differentiation, then you will usually need to rely on price to get business. And that's not the best option for startup businesses. And then we go to operations plan. Now, so you figured out this marketing plan. You have a system in place on how you're going to sell what you want to sell. Now you need to really develop an operations plan. In reality, the operations plan probably needed to come before the marketing plan, because a good operations plan is the best thing that you can possibly do. So, to develop the operations plan, you have to identify the location in which you plan to operate. Even if that means you're going to operate in your spare bedroom, you must identify that you are going to locate in this location. And you must identify, for instance, let's say you're going to have your own business and it's going to be at your house, let's say. Then what you need to do is you need to make sure that you take, let's say you're paying a mortgage, and the mortgage is $500 a month, and you have 5 bedrooms, or you have 5 rooms in your house. So you could say then, with 5 rooms, that each room is worth $100 a month. And you could say that you're having to pay rent of $100 a month for that room. And that would give you $1,200, $1,200 for your rent for that year, if you're going to operate out of your house, let's say. And so some of you are going to be operating out of your house. And let's say you're blogging or something like that. And so you will use that analogy. Let's say, though, that some of you decide you're going to rent some property. You're going to rent a building, and you need to have true estimates of the amount of money that it's going to cost you to be in that particular location. Renting a place for business on Redwood Boulevard would be different than renting a place on Flint, let's say. And so you have to remember to keep your costs down, especially if you don't have any money at all. Another element of the operations plan is when will your business open? What are your hours? Are you seasonal? Do you operate online? Do you have a building where you operate, plus you also have an online store where you operate? Do you close in the winter? Those are questions that you'll have to address. The organizational structure, I've already gone through an extensive discussion of all of the organizational structures, from sole proprietorship to corporations to LLCs to partnerships and cooperatives. And then you have to think about, how many employees will I need? Well, initially you may need 1 or 2, but a part of the operations plan is for you to identify over a 5-year period what your operations plan will be. So you may start out with 1 employee, plan to add a 2nd employee in 6 months, a 3rd employee in another 6 months, and then by the time you get to your 5th year, you may have 10 to 12 employees. You also need to list each position and what the primary responsibilities will be for each of those individuals. And you also need to identify the type of employees needed, and that means what kind of skills do they have? Do they have accounting backgrounds? Do they have finance backgrounds? Are they forecasters? Are they economics people? Are they a scientist? Are they an engineer? All of those elements are an important part of identifying employees and the number of employees needed. this is really good to have because you can have an employee's handbook, and that employee's handbook can be a derivative of the operations plan that you develop now. It's just good to say, okay, these are the people that I would need in order to make this successful. Also, space. You've got an operation, you're going to build something. Let's say you're going to build, I don't know, some kind of product out of raw material. While you have an office and maybe a storefront, you may have a manufacturing front as well, where you're using space for production needs and for people and that sort of thing. And then capacity. How many things can you make in a short amount of time or in a certain time frame? So let's say that I want to build an item that will help improve delivery of information. And I've come up with an idea, and how many of those things that I make can I make in a week and distribute those? And if the demand exists, where will I go next if the demand increases? How can I do that? Another element is your suppliers. So let's say I'm making a product, and my product is requires certain raw materials. Let's say I need titanium. And what happens if I can't get titanium? And that's a problem. And so I need to have backup suppliers, because one supplier may have it now but then not be able to supply it at another time. So I need to have resources to get from one place to another. As far as financials, am I going to have an accountant? Will I have a bookkeeper? Most of the time, people will tell you that one of the best things that they ever did was to get a good bookkeeper. This is somebody that keeps up with all of your business. And they write down everything you spend, and they write down everything that you take in, and they identify those. Then you're going to have to figure out your computer system. What kind of business system will you use? And what kind of equipment will you need? How many computers will you need? What kind of hardware tools will you need to keep those pieces of equipment serviced? Are you going to need vehicles to deliver things? Will you need desk? Will you need phones for every desk? Will you need pencils? All of that stuff adds up. Will you need tape? Will you need packing tape? How are you going to distribute this stuff to where you need it to go? And then the permits and licenses. And that comes down to federal, state, and local licensing laws. And you need to call up your city clerk and ask them where you go to get a business license and what you need to do to get that license or permit to operate. You may have to have a permit to operate in a certain location, and you may have to have a license to operate. And oftentimes you will have to display those licenses wherever your business is. Then you have to think about insurance. Well, if you've got employees, you have to pay insurance for their liability. And they may do something, and that's a liability that you as the owner are responsible for dealing with. There's other insurance, like just the building that you're in, and then the equipment inside the building has to be insured. And then you have to be insured against, let's say, somebody files a lawsuit against you and they claim that your products are not good. Well, you need to have some insurance in place to deal with that. You also need to have contracts, and you need to have legal counsel so that when you do form a contract, that it adequately represents you as the business owner or company. In addition, you will need patents and copyrights. and you may produce a product and you'll need a patent. You may do a copyright and you will need copyright coverage. And those are important elements. And then you may need to have a credit policy. Some of the guest speakers that we've had over time have indicated, well, do I get my money up front or can I bill you a month behind? Folks, in this day and age, get the money up front. It's the best policy, especially when you're starting out. Once you get to know your customers, you may provide some kind of credit policy, but right now, no, you can't afford to do that yourself. The next element is your financial plan. And that is, you're going to have to come up with your financial strategy. And what you need to do is, in this area here, you need to list all of your products and services and how they will be priced. Then you have to list how many you will sell each month for the first year. And then you apply all these totals to your cash flow projections. So let's say, for instance, you have a product or a service and you're going to price it. And let's say that whether it's a product or service, let's say it's going to cost $150 to, well, no, let's go back. Let's say it's going to cost $100 because it's kind of hard to add 50s. So unless you're making the money, that is. But anyway, let's go back. So let's say it's $100 and we're going to charge $100 for that particular product. And I've added up all my costs of my building, my equipment, and paying all this stuff off. And I've got this loan. So I've got this loan, and I'm going to have to pay this loan back over a certain period of time. I'm not going to have 30 years to pay it back. Most of the time, you guys, with a business loan, you have to pay it back in 5 years, maybe 10 years. And you're going to go in and you're going to pay it back over time. Well, then you have to price your services or products a certain way. And so the price that you might do, you would say, well, I've got to make $100, but the reason I have to make $100 is because of this. I have to make $100 because my expenses are this. And I had to sell 100 of these. So if I sell 100 items, and we can get a calculator out, and if I sell 100 items at $100, I could make $10,000. Okay, so 100 items at $100 a piece makes me $10,000. Well, if it cost me $5,000 to operate in a year, or in a month, I should say, cost me $5,000 to operate, I could conceivably, my goal would be to sell 100 of those items that I have, or to have 100 service calls or whatever that I have, so that I can actually stay in existence and continue to make money. Now, my operations amount of $5,000 comes down to me paying myself and also me paying my employees and me paying the insurance and the permits and all of that. So to make money, I have to know how much money I have to make in order to operate. Another element is that I have to obtain funding. So if I know that it's going to cost me $10,000 to get started, how would I know that? Well, I had to price everything. I had to think about phone service. I had to think about credit card use. I had to think about everything involved in operating the business. And so then if I know I have to make $5,000, but I'm not sure that I can sell 100 items in the first month, then I may have to scale back some things. So that's important for me to know that. But let's say that I can get a funding source that's willing to invest in me and my product. And that funding source wants to know how you're dealing with your revenue and also your cash outlay. So then you come down and you can have what's called this little tool right here. And this is a competitive analysis tool that each of you should actually complete in order to do your business plan. The business plan has to identify you and your products. And what are your competitors selling that's the same? And then what is their price versus your price? And what is the quality of their material versus your material? And then you have to go through and identify, well, what kind of customer service do they offer? What kind of product service do they offer? Are they reliable? Are my competitors reliable? You have to be really, really, really honest with yourself on what you think about your competitors. And you'll actually have to go in here and in these sections right here, you'll need to actually place the names of your competitors and your top 5 competitors and how they manage each of these areas here. And then that way you'll be able to look at it and go, well, can I actually start my business or do I have to stop my business?